Hey everyone, recently Jefferies has published a detailed report on 11 top stocks ideas that are likely to deliver 15 to 25% CAGR return over the next 5 years. So first of all, we'll try to understand the reasoning behind such high growth and then we'll look at those 11 stocks. Before we begin, the idea behind this video is only to share my knowledge. The only way to create wealth in stock market on a sustainable basis is via doing your own research. Buying stocks simply based on tips might make you money in the short term, but it is not sustainable. Mainly because when you invest without knowledge, even 10-20% correction creates panic. Or if the stock does not move for 6 months, then you start losing your conviction. On the contrary, if you invest in fundamentally strong companies with right knowledge, the correction only creates buying opportunities. And that's what separates the winner from losers in stock market. Alright, let's get started with this video. Before you even look at stocks, the first question is why India? See, global firms like Jefferies invest all over the world. So for them, India is not the only option. They invest where they find good opportunity at good valuation. Yet they are very bullish on Indian growth story and has 7 reasons to support their growth thesis. So first factor is India will be the third largest economy by 2027. Over the last 10 years, India's GDP has grown by 7% CAGR, jumping from 8th largest economy to 5th largest. And over the next 4 years, India's GDP will likely to grow from $3.6 trillion to touch $5 trillion, making it the third largest economy by 2027. The major tailwind for the growth is India's demographic, then improving institutional strength and improvement in governance. Second pointer is continued reforms have led the foundation of 7% long-term GDP growth. So over the years, Indian government has made multiple reforms like GST implementation in 2017 that simplified taxation and improved trade efficiency. Then they came up with bankruptcy reform that drove a massive cleaning up of corporate and banking sector balance sheet and improved governance. Then they introduced RERA, that is Real Estate Regulation Act, that cleaned up the inefficiencies in the housing sector, laying strong foundation for multi-year housing upcycle. Then government is highly focused on physical as well as digital infra that has helped the startup ecosystem as well. Third pointer is India's weight in global indices is still low at 1.6%. See, India's market cap is currently the 5th largest globally, but India's weight in global indices is still low at 1.6%. As the Indian economy would grow, it would be impossible for large global investors to ignore India. Fourth pointer is supportive global geopolitics. Unlike China, that has only one party where people don't have a choice and are bound to choose the ruling party, India has a vibrant democracy with multiple parties. Moreover, India has excellent relationship with the Western world, Japan, Australia and Middle East, making it a key beneficiary of China plus one. Then fifth factor is rising entrepreneurship and vibrant startup ecosystem driving innovation. Indian government has a lot of focus on developing digital infrastructure and there is abundant homegrown talent pool making India the third largest unicorn hub globally after US and China. Moreover, today Indian corporate debt to equity is at an all-time low. These factors would again drive the growth. Then sixth factor is India is now becoming a service export hub that now account for businesses nearly $450 per year. And several large global organizations have 10 to 20% of their employee based in India. And India's young and well-educated human resource should drive this segment to keep growing. Then seventh factor is strong corporate culture and a history of strong market return. See, India has strong institutional framework of regulators including SEBI, RBI as well as intermediaries that has helped develop a large domestic investor base. On top of that, thanks to the SIP culture, there's a visibility of nearly $50 billion per year flow into equity from domestic investors that will likely keep the valuation on the expensive side but also reduce the market volatility. All these factors make Jefferies bullish on India and personally I mentioned it many times that 21st century belongs to India and there's a huge opportunity to create wealth by investing in fundamentally strong companies. So I also have an exclusive community of serious long-term investors where I share one exclusive video every week that include key events and themes in the economy, then potential sectors and stocks that can benefit from it. Then I also track more than 300 super stocks and their quarterly results in an Excel tracker and share the details on my weekly video. Moreover, I also share my own portfolio and stocks I am bullish on. You can get these details on my website or via the join button. Now let us look at the top 11 stocks picks by Jefferies with their return potential. So first stock is from electronics manufacturing sector. It's Amber Enterprise. It has a leadership in AC manufacturing with 29% market share in India. The key reason Why Jefferies is bullish on Amber Enterprise is because AC penetration in India is just 7% versus global penetration of 30%. And India has hot weather. So AC consumption is going to grow big time with rising spending level. Moreover, Amber is now diversifying into functional components for air conditioner as well as component for various consumer durable and automobile, which is expected to grow at much faster rate. Then Amber has also expanded its mobility and electronics division. For example, it has recently done 50% joint venture with Noise, that has tie-up with Titagarh, so that would also result in high growth. Moreover, Amber has already invested significant amount with capex of 1000 crore in FY22 to 23, and this capex would normalize over the next few years. And the ramp up in the new capacity would improve company's ROCE from 11% in FY23 to 19 to 20% by FY26. Overall, Jefferies expect Amber's sale to grow at 16% CAGR and PAT to grow at 40% CAGR between FY23 to 26, and has given a target price of 9,740. Currently, Amber is trading at around 3,050, so that's 220% upside potential from current market price in next 5 years. Now, second stock is from cement sector. It's Ambuja Cement. Post acquisition by Adani Group, Ambuja Cement is working on improving cost efficiencies and control cost with measures like enhancing its waste heat recovery system capacity from currently at 103 megawatt to 397 megawatt over the period of 5 years to control power cost. Ambuja has planned a capex worth 6,000 crore in renewable power projects to take the green power share to 60% from current levels of 19%. Company intend to increase its capacity from FY23 levels of 68 metric ton per annum to 140 metric ton per annum in next 5 years. Hence, Ambuja Cement is expected to deliver strong operating performance over most peers. And Jefferies has given a 5-year target of 1250 at 19% EBITDA growth, valuing company at 17 times its FY30 EV to EBITDA. Currently, company is trading around 570, so that's 120% upside potential. Third stock is from banking sector. It's Axis Bank. As per Jefferies, Axis Bank can deliver 17% CAGR growth in advances over the next 5 years. This is due to ramp up of its lending platform, SME lending and Bharat Banking. Then improvement in private sector capex will be additional positive for credit growth. Axis Bank acquisition of Citibank's India retail platform is progressing well and has helped to premiumize balance sheet, improve CASA ratio and close the gap in credit card market. Axis Bank should deliver 18% CAGR in EPS and ROE of 18% over FY24 to 29. Another reason for outperformance of Axis Bank is its valuation, which is very attractive, where it is trading at 25% discount to peers like ICICI Bank. So as the bank would deliver growth, there is scope for re-rating. Jefferies has given Axis Bank 5-year target at 2,810 per share, valuing the bank at 2 times its FY30 adjusted PB. Currently, Axis Bank is trading at around 1,050, so that's 168% upside potential. Fourth stock in the list is from telecom sector. It's Bharti Airtel. First major factor for Airtel outperformance is due to its leadership in Indian telecom market, where only 2 players, Jio and Airtel, commands 80% of market share. Moreover, Airtel is expected to gain market share in spite of having a premium pricing over Jio. Second key factor is growth in ARPU, that is average revenue per user. Jefferies expects this ARPU to grow 80% over the next 5 years to reach levels of 380. Third factor is moderation in capex till 2030. So there is already a significant investment done in 5G and 6G is nowhere in the horizon. Hence, Jefferies expect Airtel free cash flow to grow at 21% CAGR and has given a target of 2,530 by FY29. Currently, Airtel is trading at around 1235, which means there is 105% upside potential. Then fifth stock is from power sector. It's JSW Energy. Jefferies has given 3 key triggers for the next 12 to 14 months. First is improving visibility on renewable energy. So renewable energy capacity is expected to increase from 52% in FY23 to 81% by FY30. Then second is company is also setting up 3,800 ton green and hydrogen plant in Karnataka and also setting up energy storage battery unit. If it is successfully commissioned, then there can be more upside which is not factored in currently. And third is commissioning of 700 megawatt merchant capacity. So company would benefit from higher merchant tariff in the backdrop of peak power deficit times. Then Jefferies has given 5-year target of 1100 based on its 15 times FY30 EV to EBITDA, and currently JSW Energy is trading at around 480. So that's 130% upside potential. Couple of key risks: execution delay and aggressive bidding. Sixth stock is from broad-based capex cycle, and the stock is L&T. It's a key beneficiary of India's capex upcycle with no close second competitor in terms of scale or balance sheet strength. Its peers particularly struggle with working capital financing, which impact their execution and new project wins. L&T continue to gain market share, and its diversified business ensure it can grow even when government or private sector wallet is constrained. L&T current order book is 3.8 times its FY23 core engineering and construction business revenue. So that provides good earning visibility. Jefferies has given 5-year target of 7,564 on basis of 18 times EV to EBITDA multiple for FY30 engineering and construction business, and currently L&T is trading at around 3,500. So that's around 116% upside potential. Couple of downside again, management not following the prudent capital allocation, and second could be that government infra spending could be weak. Then seventh stock is from real estate sector. It's macro tech developer, also known as Lodha Group. It is one of the largest real estate developers in India with strong hold in Mumbai and Pune region. As per Jefferies, Indian property cycle tend to be 6 to 8 years long, and last time this cycle topped out in 2013. Then it declined over the next 7 years. However, inventory has continued to decline over the last couple of years and is currently at 12 years low. So Jeffrey believes that the property cycle still has 5 years to go. Today, Macrotech has inventory worth around 30,000 crore and projects worth 55,000 crore. Now, management is eyeing 20% CAGR growth in pre-sales. Apart from Mumbai, company is also expanding in Pune and Bangalore. It is still has got potential to address large market like NCR. Considering all these factors, Jefferies has given 5-year target of 3,200 based on its 10 times FY30 EV to EBITDA. Currently, Macrotech is trading at around 1100, so that's 190% upside potential. The risk here include your job loss in the Indian economy can lead to contraction in residential sale, and second is concentration risk in Mumbai region. Then eighth stock is from healthcare sector. It's Max Healthcare. First of all, Jefferies believe that Indian hospital sector is still underpenetrated. There is far more demand for hospital bed as compared to current availability. In the future, factors like rising urbanization in India, improving per capita income, higher insurance penetration would continue to create demand for good healthcare service. Max Healthcare is second largest listed hospital in India by market cap and revenue. Jeffrey says that Max Healthcare is at an inflection point where its large capex plan is on verge of coming online. Max will be doubling its bed capacity in next 4-5 years, and as the new beds come online, they would continue to drive growth for the company. Jeffrey believes that Max can clock 17% revenue CAGR and 20% EBITDA CAGR during FY24 to 30, and margins are expected to improve from 28% to 32%. Considering this, Jefferies has given a target price of 1925, valuing company at 32 times its FY30 EBITDA, and currently Max is trading at a price of 740. So there is around 160% upside potential. What are the key risks? One could be that construction delayed various hospital sites, then slower ramp up of hospital due to incremental competition in the micro market, and third could be overpriced large acquisition. The ninth stock in the list is PSU Bank. It's SBI. Jeffrey estimates that SBI can grow its deposit at 12% CAGR over FY24 to 29 and its loan book at 13%. Moreover, SBI has built a strong non-banking platform with SBI Life, SBI AMC, SBI Card that currently drive around 23% of value. Overall, Jefferies expect SBI to deliver 18% CAGR growth in EPS over FY24 to 29 and slight improvement in ROE. And currently it is trading at very attractive valuation at 1.5 times of FY25 adjusted price to book. And has given a target price of 1850 with same 1.5 times its FY30 adjusted price to book. Currently SBI is trading at around 720, so that's around 157% upside potential. Now 10th stock is from auto sector. It's TVS Motor. First reason why Jefferies has picked TVS Motor is because it expects strong growth in two-wheeler segment. Historically, two-wheeler segment has been on consistent growth trajectory because it provides cheapest mode of transport in India. However, between FY19 to 22, two-wheeler volumes have fallen by 35% due to multiple regulation, COVID and weak economic demand. But in FY23, volumes have grown at 19% and expected to grow at moderate pace. Within this segment, TVS Motor has consistently gained market share across scooter, motorcycle and export segment. Moreover, TVS has a strong hold in two-wheeler EV segment with 19% market share in 10 months of FY24. TVS plan to expand its EV portfolio along with network expansion in India and entry in international market. Overall, Jefferies expect TVS Motor EPS to grow at 26% CAGR over FY24 to 30. Although TVS valuations are on higher side with P of 39 times its FY25 earning, however, the valuation seems justified due to strong earning outlook and headroom for future margin expansion and improving franchisee. So Jefferies has given a target price of 5,000 rupee, valuing TVS at P of 30 times its FY30 earning, and currently TVS trading at around 2,000, giving 150% upside potential. Now, final stock is from new age tech company Zomato. It's quite interesting because Zomato, that was struggling until last year, is now looking like a turnaround story. So as per Jefferies, there is a very strong opportunity for Zomato as it caters to both food delivery and quick commerce. Food service in India is underpenetrated at only 10% of food and grocery market. And within food service, online food delivery at 13% penetration is still evolving and should deliver strong double-digit growth in the next decade. In quick commerce, Blinkit caters to a growing online grocery market which is less than 10% of market today. Further, quick commerce use case is now expanding even beyond grocery and hence increasing Blinkit's TAM. Especially Blinkit growth story has been exceptional and expected to grow at 40% CAGR for next 5 years. Now, after a huge consolidation in the sector, food delivery is a two-player market with Zomato as the market leader with nearly 55% market share. Other is Swiggy. And both players are now focused on improving profitability in the last 2 years. In quick commerce too, Blinkit is the market leader and category has consolidated meaningfully in the favor of top 3 players. Considering all these factors, Jefferies expects Zomato earning to grow from 300 crore in FY24 to 6,200 crore by FY30. Wow, that's 20 times growth potential in earnings. Hence, it has given a target price of 400 rupee, giving Zomato 60 times PE multiple over FY30 earning. Currently, Zomato is trading at 160 rupee. That means there is 150% upside potential. So this is the list of 11 stocks by Jefferies that can deliver 15 to 25% CAGR return in next 5 years. If I summarize the list in terms of return in descending order, it includes Amber Enterprise, Macrotech, Axis, Max Healthcare, SBI, TVS Motor, Zomato, JSW Energy, Ambuja, L&T and Airtel. Now tell me in the comments, do you hold any stock in your portfolio and which one do you think is the most promising stock in this list? If you find this video useful, do share it with your friends. I'll see you in the next video. Till then, take care.